Imagine a company needs $100 million. Maybe it wants to buy a competitor, build a factory, or replace debt that is about to expire. So it goes to a bank, presents the numbers, and asks for a loan. The bank says no, not necessarily because the company is terrible. The deal may simply be too risky, too complicated, or too expensive under banking rules. Then a private lender walks in and says, "We'll give you the full amount. We can move quickly, keep the deal private, and shape the repayment around your business." There's only one catch. The interest will hurt, and the money behind that loan may partly come from pension funds and insurance companies managing ordinary people's savings. That is private credit, lending outside the traditional banking system. Globally, the market has grown beyond $2 trillion by broad measures. In the United States alone, it is now about $1.4 trillion, roughly the size of the American high-yield bond and leveraged loan markets. So how did something most people have never heard of become this large? It started when banks stepped back. After the 2008 financial crisis, banks were required to hold more capital and become more careful about risky lending. That made banks safer, but it also made certain loans less attractive for them. Think about a medium-sized company with a lot of debt, few physical assets, and a complicated plan to buy another business. It may be profitable, but the loan still requires more work and more risk than a bank wants. Private credit funds saw that gap and realized something simple. The company still needed money. So while banks became more selective, investment firms raised huge pools of capital specifically to make the loans banks were avoiding. In the United States, banks supplied about 48% of corporate lending in 2015. By 2025, that share had fallen to 29%. The demand for loans did not disappear. The lender simply changed, which raises the obvious question. If these private funds are not banks, where does the money come from? A private credit manager raises money from large investors, usually pension funds, insurance companies, and other wealthy institutions. The manager pools that money into a fund and lends it directly to companies. So instead of a customer depositing money in a bank and the bank lending it to a business, a pension fund commits money to an asset manager, and that manager makes the loan. It is almost like a bank with no savings accounts, no branches, and no queue at the ATM. But there is one important difference. Bank customers can ask for their deposits back. Investors in many private credit funds lock their money away for years. That gives the fund patience. It does not have to sell every loan because investors suddenly want cash tomorrow. The company pays interest. The manager takes its fees, the remaining return goes back to investors, and because the deal is negotiated privately, the lender can design the interest rate, collateral, and repayment schedule around that specific company. One fund may even provide the whole loan, meaning the company does not need 5 different banks to agree on the same deal. That sounds convenient. But why would a company accept a higher interest rate? Because sometimes certainty matters more than price. Imagine a company has 1 month to complete an acquisition. A bank may need several committees, more documents, and other banks willing to join the loan. A private fund can study the business and say, "We understand the risk. These are the terms. Sign by Friday." The company pays more, but missing the acquisition could cost even more. Private lenders can also delay principal payments or adjust the loan around the company's expected cash flow. So the borrower is not only paying for money, it is paying for speed, privacy, and certainty. And for the lender, that higher price means a better return. That is why pension funds and insurance companies became interested. Large investors have future bills to pay. Pension funds need money for retirees. Insurance companies need money for future claims. They cannot place everything in stocks, but safe bonds have not always produced enough income. Private credit offered another option. The loans usually pay more than ordinary corporate bonds. Many also have floating interest rates, meaning the income earned by the lender can rise when benchmark interest rates rise. Investors are also paid extra because the loans are difficult to sell. The idea is simple. If your money is trapped for years, you expect a better return. And because these loans do not trade publicly every second, their reported values often appear less volatile than stocks or bonds. That sounds attractive, but it creates the biggest question in the entire system. If the loan is not constantly being bought and sold, who decides what it is worth? In public markets, bad news shows up quickly. If investors think a company is in trouble, its shares or bonds can fall before lunchtime. It is painful, but the price is visible. A private loan may have no active market price. The fund estimates its value using the company's performance, financial models, similar loans, and outside valuation firms. That does not mean the number is fake. It means the number involves judgment. A fund may value a loan at 98 cents on the dollar, but if it had to sell that loan tomorrow, the best buyer might only offer 80. Until somebody actually tries to sell it, nobody knows which price is closer to reality. So private credit can look calm while the borrower is quietly getting weaker. The absence of a falling price does not always mean there is no problem. Sometimes it only means nobody has tested the price. The Federal Reserve has highlighted this lack of active trading and price discovery as one of the major risks risks in private credit. This matters because many private credit borrowers already carry heavy debt, and many of their loans use floating interest rates. When rates rise, the lender earns more, but the borrower also pays more. So the same feature improving the investor's return may be pushing the company closer to default, which leads to the uncomfortable question: is private credit another 2008 waiting to happen? Not automatically. Private credit funds have one major advantage. Investors usually cannot demand all their money back at once. Some funds lock capital away for close to a decade. That reduces the chance of a bank-run style panic forcing managers to dump loans at terrible prices. Private lenders can also negotiate directly with struggling companies instead of immediately forcing them into bankruptcy. If one fund controls the loan, the lender and the company can sit down, extend the deadline, change the repayment structure, or find another solution. So private credit is not automatically some financial time bomb, but the risk has not disappeared either. Private credit is connected to banks, pension funds, insurance companies, and private equity firms. Banks may avoid making certain loans directly, then turn around and lend money to the private funds making those same loans. Insurance companies may also gain exposure through investment structures that make the true amount of risk difficult for outsiders to understand. So the risk did not leave the financial system, it moved. And because it moved into private markets, it became harder for the public and sometimes regulators to measure. That is the real story of private credit. Banks stepped away from certain borrowers. Companies still needed money. Investors wanted higher returns. Private credit connected all three. For companies, it offers speed and flexibility. For investors, it offers more income. For the economy, it keeps money flowing to businesses that traditional banks may refuse to finance. But the price is less liquidity, less transparency, and often more risk. When the economy is strong, the trade can look brilliant, companies keep paying, investors collect interest, fund values remain stable. Everybody looks like they understood the risk perfectly, as the real test comes when borrowers begin struggling and those private loans finally have to be sold, refinanced, or written down. Because a market can remain quiet for years, that does not always mean it is safe. Sometimes it only means the price has not been tested yet.